in the next decade, in 2030, I think that the Indian GDP would grow at 11-12% for the next 5-6 years, and I feel that at least we'll be able to have a $8 trillion economy. And obviously we'll be among the third largest economy in the world after US and China.
Yeah, in fact, we've spoken so much about that, how, and the Indian government as well has a very ambitious target about where they want to see India's GDP over the next couple of years, Amrit Kal as we're calling it, Hello and welcome to Market Pillars Uncovered. This is the series where we get you insights from leaders who are shaping India's financial ecosystem. Our guest today is Mr. Vaibhav Agarwal, the founder and portfolio manager at Accelt Asset Management, an asset management firm that handles funds for HNIs, family offices, as well as retail investors. We'll be discussing what exactly is in store for the Indian economy over the next couple of years, exciting industries, his investment strategy, what Moat ROCE means, and much more. Hi Vaibhav, thanks so much for joining us today.
Thanks, Mubina, for having me on the show.
Well, I think let's start with a more broader question first. How are you viewing the Indian economy? There's this saying of sorts right now that we're the desert in the oasis because the globe is faced with all kinds of uncertainties, geopolitical ones, which in turn of course, find their way into economic problems as well with commodity shortages, so on and so forth. But how do you see India position itself and the Indian economy at large amidst all of these global problems?
Yeah, sure. So if you look at India's economy over the last 3 decades, India has grown at a nominal GDP of around 12 to 13% with an inflation of around 5 to 6%.
Okay.
So basically, there are some fundamental structural drivers to our economy. Okay. So first is the demographic dividend. So we have a very young population, and most of the other economies in the world are having an aging population. So we benefit from that because we would be the factories to the world in the next decade. And we will be what China was in the last 2 decades. Like 2 decades back, China had a huge working population. So India would be enjoying that. Second, I think that India's economy is mostly domestic oriented, like domestic consumption based. So 2/3 of our GDP is based on the domestic consumption.
Yeah.
So I think that if you look at any segment in the economy, be it consumer durables, autos, everything is very underpenetrated. So there is a huge runway for growth over the next 2 decades. So I think that is a huge benefit for our economy. Thirdly, I think that in terms of our political stability, we are very stable in our political leadership. So over the last 10 years, we have a very stable leadership, and that has been able to do structural reforms for the country, and that is benefiting us. So I think that this stable leadership would continue because there is no alternate leadership as such. And that is a big benefit because when we look at other European economies or even in US, I think that the leadership is not as strong. So that is a huge benefit for us. And overall, if we look at the Indian I think government's balance sheet also, I think it is very stable because if you look at our fiscal deficit, it has been very stable at 4.5%. So even after COVID, we saw that in a lot of economies, there was a lot of balance sheet expansion.
Yeah.
And Indian government was very prudent, and it didn't let the fiscal slip. So this is also benefiting. Our current account deficit has reduced from 2.5% in the last decade to around 0.5% right now. So overall, in every aspect, I think that Indian economy is on a very strong wicket. And in the next decade, in 2030, I think that the Indian GDP would grow at 11-12% for the next 5-6 years. And I feel that at least we'll be able to have a $8 trillion economy. And obviously we'll be among the third largest economy in the world after US and China.
Yeah, in fact, we've spoken so much about that, how, and the Indian government as well has a very ambitious target about where they want to see India's GDP over the next couple of years, Amrit Kal as we're calling it, Now, you dropped in a few hints during this answer about some industries. You mentioned about the underpenetration of certain sectors. So there's this long runway to growth, like you mentioned.
Right.
But nevertheless, if you had to just bet on one industry for now, where you see this massive boom that's coming up, what would that be?
So I think that after COVID, we have seen the rise of the quick commerce industry.
Yes.
So this industry is very nascent right now. The total retail industry in India is about $1 trillion. And the total combined revenue or GMV of these companies is around $5 to $6 billion only.
Okay.
So I think that there is a huge runway for growth for these companies. People are preferring more convenience right now. Families are becoming more nuclear. The urban and middle class population, discretionary consumption growth is rising because of the rising per capita of our country. So I think that sector should do very well over the next few years, even after 5 years, because this growth can easily be 40 to 50%, given that the market share of these quick commerce companies can grow from less than 1% to 3-4% over the next 5-6 years. So I feel that this segment is very underpenetrated and people want a lot of convenience. These companies started with the food delivery, then they went into quick commerce, then they went into a lot of different assortments. You can buy anything over there, from electronic goods to toys to any makeup or any other thing you want. You just, with a click of a button, you can just conveniently buy. So I think that sector should do very well over the next 5-6 years.
So basically you're saying that we're going to see many more two-wheelers with the delivery boys on the streets of metros, because we're anyway inundated with that.
Right, absolutely.
All right, okay. And if it was two more industries that I had to ask you to pick, Q-commerce of course is one, but what would be the other two industries that you believe are on that runway to growth?
So I think that the NBFC sector should do very well. Over the last 1 or 2 years, the RBI had a lot of restrictions on these companies. The liquidity was tight, and the RBI anticipated that there would be some consumer distress in the sector. So it had pulled the brakes before, and over the last 1 year, we have seen that the RBI relaxed a lot of norms for these companies. You have seen the liquidity rise in the system. You have seen the CRR cut and the rate cut, which will benefit all these companies. So I think in terms of growth, in terms of asset quality, and in terms of cost of fund, these companies should do very well over the next 2-3 years at least.
All right. I want to delve a bit on your investment strategy. Is there any particular focus that you have in terms of market capitalization? Because of course our investable universe comprises of large, mid, small. You also have the SME universe. How do you allocate your funds across these different market caps, and is there something that influences your decision?
So if you look at the market cap nomenclature given by AMFI, so the first 100 companies would be the large cap, the next 150 would be the mid caps, and after that around 6,000 plus companies would be small cap. So the largest small cap company would be about 30,000 crore market cap, which is not small, right? So in our investment framework, we do not have any market cap basis. We are market cap agnostic, but we tend to prefer companies which have a sustainable growth and which fit our investment criteria on a bottom-up research basis. So that's our basic approach. We do not look at market cap as such when we invest.
So let's talk a bit more about what entails your bottom-up research, your investment philosophy, or the foundations. Perhaps there are some things that, in terms of a checklist, that a company must have X, Y, Z things, and only then does it get into Accelt's investable universe. So if you could just lay out what your investment philosophy is, what do you look at when you're researching a company?
So in our investment framework, we have a model that is GMCV.
Okay.
So G stands for growth, M stands for management, C stands for capital efficiency, and V for valuation. Okay. So when we look at companies, we look for high growth. We look at companies which can sustainably grow its earnings over a period of time because of some structural tailwinds to the sector, and there is a management which can take benefit from that tailwind. And we want companies who have a good business model, who can grow it, who has a lot of opportunities, a big opportunity size in the sector, and there is a runway for growth over there. And suppose for example, if you look at HDFC Bank over the last 2-3 decades, it has grown 500x in the 3 decades, growing at 21-22% CAGR. Why that was possible is because the business model was strong. The industry was nascent, packing industry was still underpenetrated, and you are seeing the shift from PSU banks to private banks also. So the HDFC Bank grew at a CAGR much higher than what the Indian economy did. So you want those kind of companies which have a large opportunity size, which can grow its earnings sustainably because of inherent advantages to the sector, and there is a right management and right business model that can benefit out of it. Secondly, what we want is that the management should be reliable, should have a clean track record. So we do a lot of channel checks with their partners, vendors. We look at who are the employees that have worked for them. We talk to the past employees. We do a lot of channel checks and do a lot of plant visits and try to have a lot of interactions with the whole ecosystem in which the management is conducting its business, to understand the quality of the management. So if we can avoid companies which have a management which is shady kind of, which have a lot of related party transactions where the promoter, there is a lot of risk in terms of what the promoter is doing. So if you can do all those things, obviously you reduce a lot of risk in terms of allocation towards those companies. So thirdly, we look at capital efficiency. So capital efficiency, basically you look at the return on capital employed of the firm. So if the return on capital employed is more than the cost of capital and it is at least 15% plus, then it makes sense for us to invest, because if the company can use the retained earnings of the business for its growth, deploying that capital at a high return on capital employed. So those companies we look, for example, DMart. In the grocery space, we have seen a lot of retailers fail. So future retailer and a lot of retailers fail because they do not have that ROCE profile. So if you're not able to generate a high ROCE, then either you have to take a lot of debt, you have to become leveraged, or you have to dilute equity, which is not, I would say, shareholder friendly. So a lot of companies have failed, but DMart, due to its high cost competitiveness, it is able to do that and generate a lot of high ROCE, and because of that, it's able to generate a lot of cash flows. And that is why it has been able to sustainably do well over a period of time. Fourth is valuation. So last but not the least, if all the factors are there, we look for good entry points when we invest. Because if your entry point is not right, then probably even in a good company, you can generate suboptimal returns. For example, in the last 5 years, we have seen a lot of consumer staple companies. They are good on management, capital efficiency and everything. But if you have paid 80 times multiples for a 10% growth company, obviously you have suffered. And these companies, even during this bull phase, they have not made any returns for shareholders. So we look at all these criteria.
I mean, I think there's enough and more said about valuations of Indian companies, right? Because many companies, especially large cap ones, are already trading at a massive premium, to their historical averages. And I think that's more so for mid and small caps also. I just want to take forward the first point that you mentioned. You look for companies that have that, that business that can sustainably grow from here on. But to a certain extent, don't you think that that's where small and mid cap companies would have more potential? Because today, going from 100 crore to 1,000 and 2,000 crores is something that can happen, more quickly, and it's something that is more realizable versus a legacy traditional company that's already at 10,000 or 50,000 crores, and then for it to move from there, then the growth will be a little slower. So in a way, don't you think there are more opportunities in perhaps the mid and small cap space?
Yeah, absolutely. So you're right, a lot of opportunities are there in the small and mid-cap companies, because the sector would be nascent. Some of these sectors would be nascent, like in case of quick delivery or something like that, where there are not many players listed, and you find opportunities over there. Or there may be a lot of sectors where the sector is emerging out, and probably for example, EMS industry was not that popular 5 years back. So the market cap of these players like Dixon was very small at that point of time, right? So you found a lot of opportunities in that segment because the runway for growth was very high. There was structural tailwind because of the PLI incentives. So you can find a lot of opportunities over there. But in these in this small and mid cap, there are 6,000 plus companies. So you have to distill a lot of companies. You have to have the right framework for investment. Otherwise, you will make a lot of mistakes over here. So that is also the case, but obviously there are a lot of opportunities in this segment.
There's one metric I think, as I understand, that Accelt relies on quite heavily. Two actually. One is moat. And the other is ROCE. You mentioned a little bit about ROCE when you spoke about how efficiently a company is allocating capital. Let's talk about moat. Why do you think this is so important for you to consider?
So moat is basically the sustainable competitive advantage that a company enjoys. Okay. So for example, companies like Apple, they have been generating a lot of good business over the last 20-30 years, because what is happening is that they have the moat of brand loyalty. So customers who have used an iPhone, they tend to use that more often. They tend to have a lot of products apart from iPhone in the entire ecosystem, and they cannot switch from that. So when you have moats like brand loyalty, network effects, for example, in exchange, you have NSE and BSE, right? So NSE has a platform where most of the business is generated, most of the trades are done. So if you can have that kind of platform, more users will attract business, and that business would be self-sufficient and be a virtuous cycle. So no one would want to trade in any other exchange because there would be liquidity in that exchange. So you have a lot of moats like brand loyalty, network effects. You have scale advantages. So a company that like an Amazon would be having that kind of scale, which would be very difficult for any newcomer to establish that kind of economies of scale. So all these are moats which help or for example, cost competitiveness. We talked about DMart, right? So it's one of the lowest cost players in the industry. So that benefits that player, and very difficult for a new entrant to compete with a DMart. So all these examples just for the sake of giving the example, not for any recommendations as such.
Of course.
So I think that moat is an important factor, but we are gradually seeing that a lot of companies which had a lot of moat before, that moat is also disappearing. So you have to keep a check on that.
It's always very dynamic, and especially in today's day and age, no leader can stay top dog, forever. And let's talk a little bit about ROCE, because at the end of the day, it's a percentage, it's a number, and on its own, it may not really mean anything. So do you compare it with competitors, other industries? How do you look at it?
Yeah, so when ROCE is basically the operating profit divided by the capital employed. So it basically suggests that if you invest 100 rupees, what is the operating profit you are making out of that? So it is very important to have a high ROCE, more than the cost of capital. Otherwise, obviously, you have to take a lot of debt or equity raising is required. And when you compare it to other industries in that same sector, you get whether you have those advantages in terms of a big business model. If you can generate a high ROCE compared to your peers, obviously it demonstrates that you have something right in terms of the business model. Obviously, after that, you have to do a lot of checks and figure it out what is the strength of that company, which makes it a high ROCE business. So I think that ROCE is one of the important metrics to look at. Yeah.
All right. So we've discussed really micro. I mean, we've gone down to how you dissect each company and really not just read the balance sheet, but also get down to grassroots level and speak with employees and the on-ground stuff. I want to go back to a more macro bit, because like you mentioned, we have the potential to hit that $8 trillion GDP mark. We're well on our way to become the third largest economy in the world. But how do you see this translate to the markets? Because that's where people like you and I invest, right? And our viewers invest. So do you have any nifty Sensex target, perhaps over the next couple of years?
Although I don't have any targets as such, but I would say that over the last 3 decades, our Nifty Sensex has compounded around 13-14%, and our nominal GDP has grown around 12-13%. So I believe that given that our markets has not performed for last 1 year and valuations have become more reasonable, I think that with 6 to 7% growth rate and real growth rate and 4 to 5% inflation, I think that we should compound it 11-12% over the next 5 years. Probably we can double in 5-6 years. So that is my guesstimate over here.
All right. Okay, understood. And just stepping away essentially from markets and things like that, I just want to hear a bit about your own career journey. I mean, you started off in the research team of various organizations, ascended to research head, and now, of course, you're managing your own asset management firm. So could you walk us through a little bit about how your career progressed? What were those major turning points?
Yeah, so I would start from the beginning. So I was born and brought up in a Marwari business family in Calcutta.
Okay.
So I think stock markets and business runs in our blood. So I think that in 2006, I remember that I was in college and I borrowed a small sum of amount from my parents. And during that period, in the 2003 to 8 period, it was a massive bull run, probably the biggest bull run in the last 3 decades.
Yeah.
So at that point of time, I think I made 4x returns in 1 year. And I was thinking that I was doing something remarkable.
Yeah, that boosted your confidence. Yeah.
But it was blind trading as such, and there was no research or something like that. And after the 2008 crisis happened, GFC, global financial crisis happened, I probably lost all the money that I made during that phase. So that was a kind of a setback for me at that point. I was a teenager at that point, and I think it was a blessing in disguise because you can make a lot of mistakes early in your career, and that helps you, and probably that was a learning point for me. And after that, I did my CACS, which I'm a chartered accountant and company secretary. So I did my CACS in 2011, and I came to Mumbai, and I started my private. I have joined a private sector company, and I have worked across many different companies, sectors like manufacturing and banking, and I have learned a lot from I worked with a lot of industry leaders. And after that, I joined a boutique investment firm in 2018, and I have worked over there for 6 years. I joined as an analyst, and I went to become the research head over there. So after some point of time, I realized that I always wanted to be an entrepreneur, and it was probably something that I have seen all across my family. And I have invested a lot of my savings into equities over a period of time, and I have made a lot of wealth for myself. And I realized that I'm probably financially free at 35, and I want to do something of my own. So I thought that why not start our own investment firm. And I think that you have to get out of your comfort zone at some point of your life. And I think that as I have made wealth for myself, I think that I hope to do the same for my clients going forward.
I'm so glad you also shared some of the mistakes that you made, because it tells our viewers as well that, look, it's okay to make mistakes. I mean, the best of minds out there have made mistakes. Nobody is God in the market. So it kind of just encourages our viewers as well that it's all right if you've made a mistake, you've lost money, just bounce back from it and, take lessons from people like you and implement them from here on in your investment journey. Stepping away from research, numbers, Nifty, Sensex. Let's take a look at life outside of markets. Could you share a bit about what you'd like to do when you're not crunching numbers at the office? What's free time looking like for Vaibhav?
So I actually, apart from reading a lot, I enjoy watching a lot of tennis. So I'm a big Nadal fan and right now Djokovic and Alcaraz are my favorite. So I've been a huge fan of tennis, and I play a lot also. And I listen to a lot of music and probably sometimes play a guitar. So there are a lot of hobbies as such. We watch a lot of Netflix also when we get time. So that is it.
Yeah, that's the key, right? Time, finding time. All right, great. I think, Vaibhav, this has been a very insightful conversation. And I'm sure all of our viewers have learned a lot about what to do, what are the checklists you must go through when conducting research into investments. Thank you so much, Vaibhav, for joining us today.
Thanks a lot, Mubina, for having me.
Well, that of course was another episode of Market Pillars Uncovered. Thank you so much for watching. Hope you enjoyed it, and stay tuned as we'll be back with yet another one.